Let me guess. You want to invest. You really want to invest. You watch videos about stocks, crypto, ETFs, passive income, financial freedom. And every time you hear someone say, I wish I started earlier, something tightens in your chest. Because you want to start. But then you look at your bank account and it says, nice joke. Maybe it's literally zero. Maybe it's a few dollars. Maybe it's negative. And you're sitting there thinking, am I already too late? Everywhere online, people make investing sound easy. Just invest monthly. Just let compounding do the work. Just start with $1,000. And you're like, with what money? Look, if you had money, you wouldn't be watching this video. You'd already be investing. So if that's you, I need you to hear this clearly because it might be the most important financial truth you ever hear. If you're starting from $0 in 2026, most financial advice on the internet is not made for you. And if you follow it anyway, you're going to fail. Not because you're lazy, not because you're stupid, not because you lack discipline, but because the strategy itself is wrong for your situation. Here's the uncomfortable truth nobody wants to say. Investing is not the first step. And starting with investing is one of the fastest ways to stay broke. Yeah, I said it. Now, I know that sounds controversial, especially coming from a video literally about becoming an investor. But stay with me, because once you understand why, everything clicks. Here's the thing most people never explain. Money is not primarily a math problem. It's a psychology problem. When you're broke, your brain is not designed to think long-term. It can't. Your brain is thinking about survival. Bills, rent, food, transport, unexpected problems, social pressure, shame. Psychologists call this the scarcity mindset. And this isn't motivational talk. This is documented science. There was a famous Princeton study that showed people under financial stress lose up to 13 IQ points when making decisions. 13. That's the same cognitive impact as missing an entire night of sleep. Except this doesn't reset in the morning. So when someone online says, just invest consistently and don't touch it, they're giving advice to a brain that's not under pressure. But when you're broke, your brain is constantly scanning for threats. That's why you panic sell. That's why you pull money out. That's why emergencies wipe out progress. That's why long-term feels impossible. So when beginners fail at investing, it's not because investing doesn't work. It's because they started too early. That's like telling someone who's drowning to improve their swimming technique. No. First, you get them out of the water. And once you understand this, something powerful happens. You stop blaming yourself, and you stop chasing shortcuts. Because now you're building the right foundation. Here's where it gets really interesting. There are 3 financial phases every person goes through. Not income levels, not net worth milestones. Phases. The first phase is stability. This is when your basic expenses are covered. You're not in constant panic. You're not one bad week away from disaster. You might not be comfortable, but you're stable. The second phase is surplus. This is when, after essentials, there's money left over consistently. Not once. Not when everything goes perfectly, but month after month. The third phase is investment. This is where money finally starts working for you. Dividends, growth, compounding. Here's the mistake almost everyone makes. They try to jump from phase 1 straight to phase 3. They want to invest before their life can support investing. And when something goes wrong, a bill, an emergency, stress, they blame investing. But investing wasn't the problem. Timing was. I see this constantly. People buying crypto with borrowed money, buying stocks while carrying high-interest debt, investing $20 while overdrafting their bank account. That's not investing. That's gambling with hope. If you're starting from zero in 2026, your goal is not returns. Your goal is positioning. Let me explain that with math, because this part changes everything. Let's say you somehow invest $100, and you're amazing. You get a 10% return. That's $10. That doesn't change your life. Even if you double it, which almost nobody does consistently, you're still talking about small numbers. Now compare that to this. What if you increase your income by just $300 per month? That's $3,600 per year. No volatility, no market risk, no waiting. According to long-term income and labor data, People who focus on income growth early outperform passive investors for the first 7 to 10 years. Why? Because returns don't matter when the base is tiny. The base matters. Everyone loves to talk about compounding, but compounding only works when there's something meaningful to compound. Compounding zero is still zero. So if you're broke, the most important investment is not the stock market. It's your earning power. And I know that sounds cliche, invest in yourself, but let me explain it in a practical way, not motivational nonsense. Here's the exact strategy beginners must follow, step by step, without skipping ahead. First, you must stop trying to feel rich. This one hurts, because most people don't even realize they're doing it. Here's what most people don't realize. Broke people don't lose money primarily on bad investments. They lose money on identity spending, spending to feel normal, spending to feel respected, spending to feel successful, spending to avoid feeling left behind. The expensive phone, the brand name clothes, the constant eating out, the lifestyle upgrades that happen before income upgrades. Your brain is wired for social survival. It would rather look okay today than be secure tomorrow. That's why people say things like, I deserve this, or it's not that expensive, or I'll figure out later. But here's the rule that changes everything. You don't buy things to feel rich. You buy time, options, and leverage. When money stops being used to regulate emotions, it finally starts working. Second, you build a $1,000 buffer. Not 6 months of expenses. Not $10,000. Not some influencer fantasy number. $1,000. Now I know what you're thinking. That's still impossible. But listen carefully. This buffer is not about security. It's about behavior. Studies show that people with even $500 saved are dramatically less likely to fall into high-interest debt. Why? Because panic disappears. And when panic disappears, better decisions appear. This $1,000 buffer is not there to make you rich. It's there to stop you from destroying progress when life happens. Because life will happen. Third, and this is where real transformation begins, you convert time into skill, and skill into cash. If you're broke, your biggest asset is not money. It's time with internet access. That's it. Not passion, not motivation, not talent, demand, sales, video editing, copywriting, social media management, automation, AI tools, simple digital services people already pay for. You don't need to love it. You need it to work. One skill that makes $10 a day becomes $300 a month. $300 a month removes panic. Removing panic restores thinking. Thinking creates leverage. Leverage creates investing power. This is the part most people quit. Not because it doesn't work, but because it's boring. Your brain prefers fast dopamine over slow progress. That's why people chase crypto pumps, day trading, and next big opportunities. It's the same reason people choose junk food over healthy food. Feels good now, hurts later. Real wealth feels anticlimactic at first. No screenshots, no uploads, no validation, just quiet consistency. And this is where most people fall off. They want results before the system has time to work. But the system always works if you let it. Only after you have stability, a buffer, and surplus does investing finally make sense. Not when you want to invest, when your life can support investing. No high-interest debt, cash buffer in place, consistent monthly surplus. Then investing becomes boring. And boring is exactly what you want. Broad index funds, automatic contributions, no predictions, no emotions. Over 90% of professional fund managers fail to beat the market long-term. So if people with entire teams can't outsmart it, you definitely shouldn't try. The final shift is this. You don't become an investor by investing. You become an investor by thinking long-term under pressure, by choosing boring over exciting, consistency over ego, systems over motivation. Every financially successful person you admire started invisible. They didn't look rich. They didn't feel rich. They didn't talk about it. They built quietly. 2026 isn't about getting rich. It's about positioning yourself so future success becomes inevitable. If you're starting from zero, you're not late. You're early if you do it right. Start where you are. Build the base. Increase income. Remove panic. Then let money work after you've learned how to work first.